Hey everyone, welcome back to Corporate Decoder, the place where we dig into the wonky world of corporate filings, so you don't have to. Today we're cracking open Complete Solaria's latest annual report, and let me tell you, it is more than a few red flags. It is a full-blown crimson banner. I'm talking about a company that has its accountants questioning if it can continue operating, and whose debts makes climbing Everest sound like a walk in the park. Complete Solaria, if you don't know, sells solar panels to homeowners, but this report, called a 10K, gives us the full picture of their business and financial situation for the past year. We will try to get to the bottom of what went wrong. Right off the bat, the report sounds alarming. The auditors questioning their ability to even stay in business. That phrase, going concern, is auditor speak for, oh, this company might not be around much longer. And sure enough, the numbers confirm the alarm. During the last year, they posted losses of $56.5 million. Now, losses aren't always the end of the world, but when they add up to a massive $411.4 million accumulated deficit, it's not a pretty sight. It basically means they're that far in the hole. To add to the misery, they barely had $13 $4.40 of the bills. That's not all. The company readily admitted that they also found big problems with their own accounting. These are called material weaknesses in internal control. It means they don't have the correct procedures and checks in place to ensure their financial numbers are right. It is as if a construction company cannot count the number of bricks they need to build a wall. It is absolutely detrimental. What exactly is wrong? Well, the problems seem to be everywhere. They do not have enough qualified accounting personnel. Their risk assessment isn't up to par, and communications between different teams are poor. It's not just one thing, it's a systemic failure. And these problems meant they couldn't file this very report on time, which limits their ability to raise money. Basically, the company cannot function. But it's not all the company's fault. International tariffs hurt their bottom line, so it's harder for them to acquire equipment. This is a warning that the solar business relies on governmental incentives. If those incentives expire, demand for solar panels could take a nosedive. That's a big external risk they have to navigate. Another issue is reliance on a few suppliers for solar panels. Any disruption could cause major headaches, including delays and lost sales. They basically said component price changes could result in sales and installation delays, cancellations, and loss of market share. Here's another basic problem. They write that adoption of solar power is not as widespread as they want it to be. This section highlights a significant reliance on CEO Thurman Rogers. Their warranties on the panels might cost more than they've set aside for them. It is as if you are an insurance and there is a hurricane coming, but you don't have enough money to pay out the claims. This is a subtle but important point. A few people continue to hold a lot of power over the company's direction, which may not align with all investors. Their stock price may be very risky and a downward spiral might appear. But hey, they did manage to more than double the amount of shares outstanding, so at least more people own their shares. Jokes aside, this could dilute the stock price even further. Let's quickly look at some key numbers. Tavlid, their revenue is up 24%, but digging deeper, most of that came from acquiring another company, SunPower. So is their core business growing, or are they just buying growth? Gross profit increased from 20% to 36%. It is good news if they can maintain this improvement. General and administrative expenses nearly doubled, soaring by 139%. This is not a good sign. They claim that it is due to the SunPower acquisition, but it is hard to believe that all of it came from that. The company also has many of those forward purchase agreements that are designed to get cash. If you will recall from our stock explanation, it's a double-edged sword for a struggling company. Their cash on hand increased to $13.4 million, but it remains very little compared to the massive scale of debt. To summarize the financial overview, expenses increased almost as much as revenues did, and with that, accumulated losses did not decrease. This is another can of worms they will need to untangle. However, I can't commend them on their willingness to disclose their plans to protect our critical computer networks and data. This is good management. Finally, digging into who owns the company shows that management maintains a strong grip on it. That's it for the highlights. And now it's time for my 2 cents. Complete Solaria is in a really tough spot. Their acquisition strategy seems risky, increasing their size but adding a lot of debt to the balance sheet. The risk factors about government incentives and adoption of solar panels are also concerning, given their reliance on these factors. The material weaknesses in accounting controls is a huge problem that needs immediate fixing. If they cannot, nothing else matters. Finally, there is a massive web of debt, and whether the company will survive is a serious question mark. This report paints a picture of a company struggling for survival, not sustainable growth. While the increased market share may look appealing, the cost to achieve that and the existing challenges raise serious questions for investors. Thanks for watching, and let me know your thoughts about Solaria. What do you think they should do? Make sure you like, comment and subscribe.